Hello, everyone. May I start by thanking you all for your support. We value the confidence and faith that you have reposed in Silverdale Bond Fund over the years. We are committed to providing you our best service at all times. A special thanks to each of you who have logged in from across the world, right from Australia to India to Hong Kong to Middle East and UK. Welcome to the H1 Silverdale Bond Fund Review 2019. Your fund has delivered 8.29% return for the first half without any strategy drift. We continue to be focused on high quality bonds with over 75% in IG, short duration, less than 2 years, and low volatility. May I now invite Mr. Sanjay Guglani, CIO of Silverdale Funds, to take you through the first half performance and share our market insights. In order to make it interactive, after the CIO's presentation, the floor would be opened for questions. May I request you to use the hands up option, Zoom option, or simply raise your hand so that we can unmute you and take the question. Over to you, Sanjay.
Hi everybody, how are you? Good to see a lot of familiar faces there. We're just waiting a couple of our friends to join. Those have pinged me to hold for a few seconds, so I'm just getting them to come on board. Just to remind people, those who want to join my audio, you have facility to join my audio too. Okay, so let's start the crossover there. You can see my presentation. Excellent. Thank you very much once again for joining. As you must have noticed, the change in our cover that's taken from our new website, which reflects our ethos, innovation, and agility. Theme of the competitive support best illustrates our commitment to be competitive while holding dearly the principles of fair play. In terms of last 12 months, we've given a return of about 9%. In the first half year, we have given a return of 8.29% with no drift of strategy. Most of the returns came, half the returns came from price appreciation, and the next remaining half was in terms of the carry. As many of you have noticed, we have increased our dividend from $8 per share last year to $8.40 per share. This demonstrates our confidence to be able to maintain high level of dividend to our investors. To put it differently, over last 5 years, we have given you 62% return versus the bond index, which is given about 34% return. To input in other words, it's 8.54% per annum. Not only returns, but you will also notice that in case of most parameters, we are among the top, as evident from the radar graph which you see. There is no material change in terms of our investment grade quality. We are about 78% into IG. In terms of duration, it has marginally increased from 1.65 years to 1.69 years. There's been a huge change, of course, in terms of geographical distribution. We today own about 109 securities from 20 countries, including from Germany, for where we bought the first bond. The key highlight, of course, is the fact that, as you must have noticed, the China allocation has increased from 23% to 28%. That was primarily because of the reduction in leverage, which I will talk to you in a while. And of course, adding a bit of Hurong, Country Garden, Shimon sector there. We still see a significant value in Chinese credits. This is without considering the tailwinds from the fact that the Chinese case would be and are being included in the various indices, and of course the prospects of further policy easing. The other significant change in the last 6 months has been the Turkey exposure, which has reduced from 10% to less than 3%. And that's principally because we have not replaced most of the bonds which have matured or sold, as we don't see much juice in the Turkish credits. We're closely following the S-400 missile delivery from Russia, which could result in the US sanctions. At the same time, we are sanguine about reduction in the local interest rates, which could potentially provide us certain interesting opportunities. The other key movement you would have seen is in terms of reduction of Thailand. As you remember, we had one bond from Thailand, namely PTT, which was matured in June 2019, and we got the proceeds on time. US is seen a reduction from 21% to 18%, specifically because of booking profits in AT&T, Macy's, Pitney Bowes, etc. out there. The France exposure slightly increased to about 6% as we added BNP Paribas, and therefore it has come out from the others, a separate item. Norway has increased to about 4% with the addition of DNB. Mexico has again increased to about 4% of addition of Pemex, while we exited CEMEX out there. The other minor changes, of course, in terms of India, which is marginally increased by 2%, and that's primarily because of the fact that we booked profits in Shriram Transport and Yes Bank, and added a bit of Indiabulls and Indus in there. Russia got reduced primarily because of the El Rosa bonds, which had a buyback, and we made an interesting and decent profit there. Switzerland increased marginally again. And in terms of others, today in others we have about 11 countries, and these include Canada, Qatar, Great Britain, Switzerland, Indonesia, Netherlands, Czech Republic, Germany, and of course Turkey. So as you might have noticed, we have been pretty active in terms of realigning our portfolio to reduce the risk, make it more diversified, and making it more opportune in terms of the market developments. In terms of sectors, as usual, we try to maintain our exposure to financials to below 50%. We continue to maintain that, and that's again primarily in terms of reducing the volatility in the market in the portfolio. In terms of the key names, again in the financials we added, as I told earlier, BNP Paribas and DNB across Terra, besides Indiabulls and IndusInd. This is very important. As you must have noticed, we've reduced the leverage from 63% to 58%, 5 points reduction in the in leverage, which also means that we have increased our headroom to marginally above 10%, and this is primarily in response to the market volatility which is induced by the phase 1 of US-China trade war, and as we enter the phase 2 of the China-US trade war, we would crawl up our leverage marginally above 60 in the coming months. No change in strategy. In terms of our yield, as you notice that our yield, leverage yield is at 12.5, which is historic high. And as you notice from the December quarter, typically a high yield results in uptick in terms of our NAV. So with the unleveraged yield of 7%, a leverage yield of 12.5%, I'm sure most investors know what they should be doing now. Coming to a more medium-term outlook, so from medium-term perspective, we have given a positive returns in 68% of the months, and by definition, when we are up, we are much higher, when low, we are much lower, and that gives us the positive performance. This is, of course, from the company which you get every week. As you must have noticed, our assets increased by almost 17% from 150 million in December to 180 million now. The other important thing which I want to highlight is the fact that we have changed the way the growth NAV is being computed to be in alignment with the industry practice. And that has resulted in terms of uptick in the growth NAV by about $2. Just to give a flavor, step back, earlier the way we were computing the growth NAV was in terms of the ex-dividend NAV plus the dividend. Namely, we were not accounting for the returns earned on the dividend invested, which made the NAV disclosed by us to be lower than disclosed by the various databases, including Bloomberg. So in order to avoid the confusion, which some of you pointed out to us, we have now made it in line with the industry, wherein we are not taking into consideration the return earned on the dividend reinvested. Just to highlight to you, this does not impact in any way your subscription redemption amounts, which would, as usual, continue to be on the ex-dividend basis. In terms of the top holdings, as you are aware of it, our top holding is DNB Bank, the largest bank in Norway, Citadel, which is a global leader in terms of hedge fund. Just to point out to you, the money we have given to the hedge fund manager and not to the hedge fund itself. Pemex, which is, the largest entity in Mexico. Seagate, which is a duty-free producer of hard disk in the world. Country Garden, the largest producer of mass market in China, and on 3 largest in the country. The gross floor area is close to 80 billion for them. Crédit Agricole, the largest bank in France. Braskem, the 3rd largest producer of polypropylene in the world. Chang Development, the larger stocks there. Turkey Herkesi, which you are aware of, in BNP, which, as you know, is the largest bank across again. As you notice that most of the top holdings are companies which are the largest in the world, or at least largest in the country, which gives them a strong backing from the respective governments. In terms of returns, as I mentioned, we've given about 8.25% return as compared to 9% return by the indices, which is broadly in line. That's primarily because we have been more conservative than the market. As you are aware, typically the market has a duration of 45 years, or duration is less than 2 years. Very specifically, there's no change in strategy, and we continue to focus on the IG bonds. As mentioned earlier, we increased the dividend from $8 to $8.40. For the Q2 2019, we paid the 17th quarterly dividend of $2.10 per share, which implies a yield of 6.64%. This low duration and the high headroom enables the fund to actively align with the market without taking undue risk. To summarize, we have given a return of 8.28% in absolute terms in the first half of the year, despite the choppy markets and a sharp change in the interest outlook. Credit spreads continue to be even wider than the start of 2018, which points towards the high returns in future. The more important and key things to keep in mind is the fact that the slowing global economy with the dovish interest rate outlook are likely to result in significantly superior risk-adjusted returns for leveraged bond portfolios. That's very important to keep in mind among the noise, because people do get carried away that global market is coming down, but stock market will look up, contradiction by itself. This is our last slide, and to conclude, we continue to give you a return of 8 to 10% per annum, maintain a headroom of 5 to 10%. We never got a margin call in the fund since inception of the fund house. A high quality of 78% IG, duration of less than 2 years, precisely 1.6. We are well diversified over 109 securities, and with zero defaults, zero non-USD exposure, a dividend flow of $8.40 per share, which gives a dividend yield of roughly 6%. And the most critical portion of the fund, as you're aware of, is the fact that the leverage is taken by the fund and not by the investor. So there's no margin calls, there's no personal guarantees. Our fungible cash flow model continues to help us to outperform. We had 6 cases of investment grade upgrades to buyback this year, which added alpha to our returns. As I mentioned earlier, we've given 8.29% absolute return for the 6 months. It's absolute return, not annualized return. So 8.29% absolute return despite the choppy markets. The important thing to notice is that we are well positioned in terms of the market opportunities which we see further as going further. And this would also manifest from the fact that the credit spreads are still wider than start of 2018. Just to summarize in one line, it's a unique internally leveraged bond fund giving you 8 to 10% per annum with 6+ years of track record, Sharpe ratio of circa 1.5, while investing into investment grade, short duration US dollar bonds and paying 6% per annum in terms of dividend paid quarterly. I also take this opportunity to share with you the partners, those who have helped us to reach where we are. And I will take your attention to the silver day stars you would have seen in some certain monograms there. These are the people, these are the banks, institutions, those who provide leverage against the civil bond fund, a strong endorsement of our solid and stable performance. With that, I conclude my presentation, and I'm happy to take any questions which you might have. I can't see it. Okay, so let me just share with you my thoughts on the most commonly asked question to me is in terms of the US-China trade war. So let me begin by pointing out to you one single point, which is that US-China trade war is an effect and not the cause. The cause is in terms of dominance, global dominance on economic affairs, and the fight between the US and China in terms of dominance. So this is something which happens every half a century to a century. The last big fight we saw was between the Great Britain and US. Interestingly, the key way it happens is very important, because one of the key determinant in terms of the trade war is the technology. And of course, the first technology was the great China tea haste, where the Britain was theoretically, technically at least, stole the tea technology from China and use it to produce tea in India and change the world trade. The second key trade war, as I mentioned earlier, was between US and Britain after the Second World War, wherein the father of Industrial Revolution in United States of America, Stuart Samuel, stole the steam engine technology and made US what the US is. And of course, the second key immigrant who stole the power loom technology from Great Britain. So this acquisition of stealing technology is very interesting, because exactly what US is now accused China of. So for me, they are the classic indicators of the classic fight for dominance. We saw it earlier also in the 1980s between Japan and US. Now, Japan-US is very interesting trade war, because they determine in terms of how the trade wars are unfolding in the modern world. So what we will see is three things will happen. Number one, the tariffs would be raised to 25%, a number which is a magical number which happened way back in the Roman Empire, in the Great Britain fight, in the Germany fight, etc. out there. Number two, we will see that restrictions in terms of imports and exports, and which will end up in terms of what was called for Japan, the voluntary cutting of the exports. And number three is most interesting thing, and is most interesting from the current perspective of the blockchains and bitcoins and the QE, which is the fact that the currency would be used as an instrument of play. So to remind you, we had a plaza accord in case of Japan, wherein the Japanese currency appreciated almost 50%, and which was a body blow to Japanese economy, where the export shrunk and the trade war was called off. And therefore, we didn't have Japanese dominance. Having learned the lessons, I'd be surprised that China would ever make that horrible mistake of allowing a very significant increase in the currency. Now comes the interesting portion in terms of trade war, which happened just for 10 years ago in 2008, 2010, when Mother China decided to subsidize the solar panels. We saw that US put huge amount of duty, and what China did was very straightforward. The China exports to US crashed by 80%, and surprise, surprise, the Taiwan export to US increased by 400%. And we know all what the story was. So this is something ongoing thing. From the investor's perspective, we have to be careful. Most importantly, that this US-China trade war is going to last at least 10 to 15 years. More likely than not, and I would stake almost my neck out by saying almost like 4:1, that China would win it. and which basically means that in terms of the global allocation of the portfolio, people have to be extremely careful in terms of how they deploying their monies over the next decade and two. From our perspective, we see as an opportunity in terms of being able to add more alpha by focusing and understanding what's going to happen in the medium to long term. Our portfolio is designed to be a medium to long term portfolio and not to take care of short term movements. That's not our objective. We would always be relatively low vol funds because we believe that we are committed to giving to you a stable return. As you all know, we believe that we need to maintain a minimum dividend payout of 6% per annum at the lowest end, which we continue to do it, and we shall continue to do it. Should you have any other questions, happy to take across of that. But in terms of broad portfolio going forward, you will see A is more diversification, B, marginal increase in duration, marginal increase in leverage, but no change in strategy.
Any questions for Sanjay?
Yeah, hi Sanjay, this is Thomas here from Crystal. Thanks very much for the great presentation and for your hard work. I would have a question regarding your view on corporate leverage, whether it's in the US and Asia, and what's your view on the trends there over the next 12 to 18 months?
Okay, so let's get the facts on the table first. First is that in terms of corporate leverage across out there, and specifically into three pieces. Piece number one, there is general belief that we have more high yield than IG. The answer is no. So if you look in terms of quality of companies across out there, we have more IGs across out there, and specifically the high yield are being new issuers, and not that the existing issuers have actually relegated down to high yield. Number two, in terms of the books of the IG bond corporates, the books of IG corporates are far, far better than what we saw in early 2000 and early 2010. So if you look in terms of, for example, debt servicing ratio, or purely in terms of the top lines and bottom lines, these companies have actually utilized the low interest regime to reduce their and elongate their debt profile. That takes me to the last bit of it, which is in terms of high yield. Yes, we have seen new issuers which are high yield, which are coming into market. Yes, we need to be careful of many of those, because many of those new issuers don't even have a track record for us to fall back in terms of knowing how they would do in terms of pressure. Caveat two again. First caveat is that because of the fact that the interest rate outlook is dovish, therefore we don't see pressure coming to them an absolute immediate term. But second point also equally important, that we also know that the global trade, global economic growth rate is coming down, and therefore these high yield would have a pressure in medium to long term. Right? I have excluded the role in terms of capital central banks there, and I assume that's not the key portion, but happy to elaborate if you require any further thing on those questions.
Thanks.
You're welcome.
Any other questions? In case we don't have any other questions, we can end the call now. Of course, please feel free to drop us an email if you have any queries which you want to get addressed by us. We would be happy to address it. Thank you so much for logging on to the call, and we look forward to seeing you next quarter. Thank you.
Thank you very much. Appreciate your support to Silverdale, and we invite you to our new website, silverdalegroup.com, and look forward to your comments through the website, and of course, feel free to write to us. Thank you once again.